Hi, welcome to this Tuesday talk. And today we're going to talk about can you settle for index returns? Why is it we have such a problem? And that's a behavioral problem. That's not a technical problem that we have settling for average returns in life. But I'll show you why average returns in the market are not average returns, but are actually returns which will beat most other professional fund managers also. But before that, let's just look at what happened last week. Not a very great week in the markets, as those of you who've seen the markets and have been following. So quality fell the least. Low volatility also fell about 5%. That's quite a bit. Momentum took a beating of 7%. Small cap and value both took a beating of around 8% odd. On a monthly basis, that is on a weekly basis. On a monthly basis, small cap and momentum and value all down over 15%. The small cap has hit the most at 20%. Quality and low volatility, as we expect them to behave, they are behaving in line with their characteristics, down about 7 to 10%. Market is in line, still holding strong, I would say, at this point, in spite of the fall last week. They've not fallen as much as the small cap has. Year to date, it's again small caps, momentum, which are down. Momentum down about 18%, small caps down about 26%. Quality doing fantastic job at about down about 7%, and low volatility down about 12%, in line with the market. So, which is why we always say that if you are investing in factors, it's good to have exposure to more than one or two factors, and not unless you are like a full-time investor, DIY investor, you understand what you are getting into when the risks that you take when you invest in a single factor. You should not be investing in a single factor. You should be having at least two or three different factors which have low correlations with each other. With that, let's look at the trends of the factors, and they are all down. Nothing changes in the last 4 or 5 weeks. Sectors. So no sector in the green last week, not even one. Not even FMCG. Very surprising. Auto, pharma, banks, down in line with the market, but metal IT taking it on the chin. Energy down 6%. IT down 8%, metals down 9%. So that trade is reversing, that the commodities trade is reversing, which is fairly clear. More clear in the monthly returns, metals down about 25%. That's a lot. Energy is down 15%. IT is down about 15%. Auto and FMCG, auto surprisingly down the least, and FMCG down about 5%, which is in this market is not bad at all. Let's look at the year-to-date performance. Year-to-date, energy still retaining its slim gains, about 7%. IT down the most, 30%, and the rest, metals down 15%, which were positive until about a couple of months ago. It's down 15% now, given up all its gains. And who knows, with oil coming down, maybe even energy gives up most of its gains. But this week has started well for the market, so let's see how it ends on Friday. So let's not get ahead of ourselves, as the US markets were closed yesterday. So let's see what happens when they open today. Let's look at the trends. And so, there's been a development in the trends also. Last week, at least auto and energy were in an uptrend. This week, even that has gone, and not even one sector is in an uptrend now. So we've seen that not one sector was in the green on a weekly basis, and now not even one sector is in an uptrend. This is a medium-term trend that we look at, the weekly trend, which is based on the 40-week return. So auto, which was trying to fight the trend, has given up. FMCG gave up a couple of weeks ago, and energy gave up this week. So if you want to get all this in your inbox, you can subscribe to Factor Investor, subscribe.com. This week we should be sending out the Factor Investor report. This is our factor all weather dashboard. So nothing changes here. For June 22, as we had said, we are in a risk of 100% risk off mode, and we continue to be in gold in this model. But you can be in cash or gold, whatever. This is just our allocation. So let's move on to the topic for the week, behavior gap. Quick refresher. We've done this in the past two videos. We've shown you why there is a behavior gap, why investors get in and out at the wrong time. It's because of behavioral biases like disposition and confirmation bias. We've looked at these gaps. Uh, we looked at the importance of the big picture, why in the big run, so the market has seen so many crises, so many ups and downs, but the long-term trend, if you zoom out, has been up, and that's what we have to focus on in these times. Today, I'll talk about slightly, you know, from behavior. I'm going to just move to funds. So most people don't want to invest in an index fund because they say that no, I want more than index return. But I'll show you with data with that most uh, active mutual fund managers are not able to beat the index. So just a small bit of history here that the Vanguard Group, which launched the first index fund in 1976, had a disaster of an NFO, and I think they tried to raise about $100 million. They could raise only 10, but thank God they persisted, and today they manage $8 trillion after 40 years. That's trillion with a T. Even Warren Buffett wants that after he passes on, that his inheritance to his wife should be in a. He specifically mentioned Vanguard S&P 500 index fund, and in 2016 he in fact invited Jack Bogle to the Berkshire Hathaway meeting in Omaha, and in front of all his shareholders, he acknowledged his contribution to the investing industry in whole. He's one person who he feels has done uh, the most for investors globally, and that's a big endorsement coming from an active investor. So what about India, you may ask? And so thankfully in India, we have this PUR report, which comes out every 6 months. And so you can see on a 5-year and 10-year basis, on a 5-year basis, 82% of large cap funds have failed to beat the index. 67% have failed to beat the index on a 10-year basis. In the ELSS space, something similar, 80% and 60%. Even in the small cap and mid cap space, where we say that there is alpha, majority, which is over 50%, on a 5-year basis, that's about 58% and 56% of funds have failed to beat the index. So when you're investing in the index, you are getting average market returns, but those returns, remember, are going to be more than what you would probably. When I say probably, look at the probability: 82% on a 5-year basis in an equity large cap fund, and 60% on a mid and small cap based fund. So the probabilities are in your favor. That's what markets are all about. It's all about probability. So with that, I'm going to leave you with again a quote from Warren Buffett, that he says that if you invest in a very low cost index fund where you're not doing a lump sum, but you're doing a SIP over 10 years, you'll do better than 90% of the people who start investing at the same time. And if you remember that famous bet that he took with a hedge fund manager, uh, who won that bet? It was Warren Buffett. With that, thank you. Nothing in this video is investment advice, purely for education. Please consult an investment advisor before investing. You can follow me on Anish Daily. You can follow us on QED Cap, and you can visit us on QEDCap.com. Please don't forget to like, follow, and subscribe our YouTube channel. And this Friday, we're going to be coming to you with a live. So, stay tuned for that, and we hope to see you there. See you next week.